Have you ever wondered why multifamily housing is increasingly becoming the darling of real estate investors? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In the third quarter of 2025, multifamily housing emerged as the clear leader in commercial real estate investment activity, according to a comprehensive report from CBRE. The sector attracted a staggering $41.9 billion in investment volume, marking a significant 10% increase from the previous year. This impressive figure accounted for a substantial 37.4% share of all commercial real estate transactions, highlighting the robust demand for multifamily properties. Single-asset multifamily transactions alone reached $35.3 billion in the third quarter, reflecting a nearly 18% increase from the same period last year. On a trailing four-quarter basis, multifamily investment soared to $155.4 billion, a 21.6% increase year over year, capturing a 34.9% share of total commercial real estate investment. This demonstrates the enduring appeal and resilience of multifamily investments amidst various economic conditions. In terms of geographical performance, Las Vegas led the way with a remarkable 113% year-over-year growth in multifamily investment, totaling nearly $2 billion. Seattle followed closely with a 92% increase, reaching $6.2 billion in volume. The greater New York area also showed strong performance with $13.2 billion in transactions, representing a 73% growth. Other notable markets included Portland, San Francisco Bay Area, Minneapolis, and Orlando, which all experienced substantial growth ranging from 50 to 66%. The lending environment for multifamily properties also showed meaningful improvement during the third quarter. Multifamily loan spreads tightened by 27 basis points year over year, driven primarily by lower agency loan spreads, contrasting sharply with the broader commercial property loans, where spreads widened by 14 basis points. Government-sponsored enterprise lending saw a dramatic increase, with agency origination volume jumping 57% year over year to $44.3 billion. Despite rising investment volumes, multifamily property valuations faced some pressure. According to the MSCI Commercial Property Price Index, multifamily was the only major sector experiencing year-over-year price declines, with values down 0.8% in September 2025 compared to the previous year. However, multifamily assets still delivered the second highest annualized total return among major property types at 5.5%, trailing retail but exceeding industrial, hotel, and office sectors. Private investors dominated multifamily acquisition activity, accounting for the majority of the $67.9 billion in total private investment across all property types in the third quarter. Institutional investors increased their volume by 17% year over year, while REITs and public companies also showed growth, up 14%. Cross-border investment in U.S. multifamily properties remained stable, reflecting continued international investor confidence in the U.S. apartment market fundamentals. The improving lending momentum signals that capital availability, which previously constrained transactions, is no longer a significant barrier to investment activity in multifamily and other commercial real estate sectors. This is great news for investors looking to capitalize on the multifamily sector's strength and resilience. Gary Marr. In today's rapidly evolving real estate market, landlords are faced with an increasingly challenging environment, especially with the introduction of more stringent rent control measures. As we navigate through these changes, it's essential to consider the implications for both current and prospective landlords. Rent control, while designed to protect tenants from exorbitant rent hikes, poses a significant challenge to landlords who must balance the financial viability of their investments with the regulatory constraints imposed by these measures. In Ontario, where cities like Hamilton, Niagara, Burlington, Oakville, Kitchener-Waterloo, London, and Cambridge are experiencing a surge in rental demand, the pressure is particularly intense. According to Gary Marr, the introduction of rent control has led to a complex situation where landlords are questioning the long-term sustainability of their investments. The concern is that while rent control may stabilize housing costs for tenants, it could deter new investments in the rental market, leading to a potential shortage of available rental units. Marr highlights that landlords are now more cautious about entering the rental market, given the constraints on how much they can increase rents annually. This caution could result in a slowdown in the development of new multifamily housing projects, particularly in regions like Ontario, where the demand for rental properties is on the rise. However, it's not all doom and gloom. As Marr points out, the market is resilient and savvy investors can still find opportunities. The key is to adapt to the changing landscape by focusing on value-add strategies and exploring areas with less restrictive rental regulations. In Ontario, cities like Hamilton and Kitchener-Waterloo continue to offer promising prospects for those willing to navigate the complexities of rent control. Ultimately, the question remains, will anyone want to be a landlord in a rent-controlled world? For some, the answer is a resounding yes. With the right approach and a willingness to adapt, landlords can still thrive in this environment, capitalizing on the growing demand for rental housing while ensuring their investments remain profitable. Now let's dive into a practical guide to Canadian real estate investment trust investing in 2025, as explored by Tony Dong. In this comprehensive guide, Tony provides insights into how investors can approach Canadian real estate investment trusts in today's market, which is characterized by speculative valuations in sectors like artificial intelligence and quantum computing. While these sectors see sky-high multiples, Canadian real estate investment trusts have been lagging behind, presenting a unique opportunity for investors. Tony highlights that even with distributions reinvested, the S&P/TSX Capped Real Estate Investment Trust Index is still below its pre-pandemic highs, with little sign of a sustained rebound. However, this divergence could mean that Canadian real estate investment trusts are one of the few asset classes not overvalued today, offering genuine recovery potential as interest rates fall. Many Canadians still view real estate as a path to financial independence, yet few consider the benefits of real estate investment trusts, which offer diversification and liquidity that private property ownership cannot match. Real estate investment trusts are unique in that they are pass-through vehicles exempt from paying corporate income tax as long as they distribute most of their taxable income to unit holders. They generate revenue primarily from rent, and their distributions, often paid monthly, tend to be higher than average dividend yields from stocks in other sectors. Canadian real estate investment trusts span several subsectors, including multifamily housing, industrial, office, and retail properties. Tony emphasizes that to value real estate investment trusts, investors should focus on metrics like funds from operations, which adjust net income by adding back non-cash expenses like depreciation. It's a more accurate measure of a real estate investment trust's cash-generating ability. Another critical metric is the price-to-funds from operations ratio, which tells how expensive a real estate investment trust is relative to its cash flow. Comparing this ratio to historical averages and peers within the same subsector provides a fair sense of value. For those considering real estate investment trust exchange-traded funds, Tony discusses both passive and active options. He suggests that in a concentrated sector like Canadian real estate investment trusts, an equal-weighted approach, such as the BMO Equal Weight Real Estate Investment Trust Index ETF, strikes the best balance between cost, diversification, and performance consistency. Active management can offer the flexibility to step outside the narrow Canadian real estate investment trust universe, potentially delivering better returns. Ultimately, whether you choose individual real estate investment trusts or exchange-traded funds, it's essential to prioritize quality, diversify across property types, and consider tax implications. With the right strategy, Canadian real estate investment trusts could be a valuable addition to your portfolio, offering robust income and the potential for capital appreciation. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.